Let me introduce our panel here this morning. You've already experienced Maria Demertzis in the fireside chat with Christine Lagarde. She's a deputy director at Bruegel and professor of economic policy at the School of Transnational Governance at the European University Institute in Florence. To her right, Andreas Dombret is a global senior advisor for Oliver Wyman and a member of the board here at the Atlantik-Bruecke. You may know him from his long career in the private sector, but especially as a member of the executive board of the Deutsche Bundesbank, where he had responsibilities for financial stability and oversight. And to those on the international circuit, he's of course well known as the Bundesbank's IMF deputy and his roles that he played at the SSM and the Basel institutions. Two to my left, Geoffrey Okamoto has been just recently appointed to lead Goldman Sachs' efforts on international public policy, coordinating cross-jurisdictional issues and engaging with global policymakers. But again, he just left his position not too long ago as the IMF's first deputy managing director, where he served under Kristalina Georgieva. And he also was acting undersecretary of the US Treasury for International Affairs. And the connection with the Atlantik-Bruecke is also very strong, as he was a member of the Young Leaders program at the Atlantik-Bruecke. And right here to my left, Philippa Sigl-Glöckner is the founder of the think tank Dezernat Zukunft, which focuses on monetary, financial, and economic policy. She has worked for the German Federal Ministry of Finance, for the Liberian Ministry of Finance, and the World Bank, among other activities. She is a member of the Economic Advisory Council to the Executive Committee of the Social Democratic Party in Germany here. And she also was part of the Young Leaders program of the Atlantik-Bruecke, as well as being mentioned by the Capital's 40 under 40 list. So welcome to our panelists. We're going to do the discussion in kind of two separate parts. The role of the dollar and the euro is important, but it cannot really be discussed without getting a feeling of where we are right now in terms of monetary policy and what's happening to inflation and exchange rates. And the best way maybe to start this discussion is to ask Maria, who just had the fireside chat with Christine Lagarde. Maria, what did you think of the interview, and where do you see the difficulties for the ECB, but also the Fed and other central banks right now of reining in inflation? How much help do they need from finance ministries and other actors? What is your assessment of where we are right now with monetary policy?
Yeah, thank you very much, Martin, for the introduction and for the question. I think that is a very important question. I think I'll start by saying that we heard this morning President Lagarde talking about the differences between the US and the euro area when it comes to inflation. And I think that's an important distinction because it should be guiding policy. And there are very different parts of the monetary policy cycle, and therefore it requires very tailored action. Now, in reflecting in the 1 hour that we had between the two events on some of the issues we had this morning, perhaps I'll say three things. The first one is about the most difficult one, what to do, why we are where we are now, and what to do next. And I mean, I think there's both good arguments to say that we have been delayed, we being in Europe, delayed in on the upward side of the monetary policy cycle. I mean, the European Central Bank had been very clear in the sequencing, in the need for sequencing. First, we're going to stop the quantitative easing, or spell it down, and then we're going to increase interest rates. They could have done that part earlier. This is why I asked the question last September. We were seeing the numbers going up. There we were still on the camp that this is temporary, but very quickly became clear that some of these things were going to be, if not permanent, permanent, because permanent is a very long time, but at least entrenched. So I think there is a good reasons to argue that we have been delayed in sort of getting into that part of the monetary policy cycle. That said, and this is what the next question is, what do we do now? Given where we are, what do we do next? And I think even there are problems, because now it may be too late. What I mean by that is that by the time we will see the effects of the upward cycle of monetary policy, we are in all likelihood going to be out of the war, in which case the monetary policy actions that we take today may actually be detrimental to growth. And is this really what we want to do, given the uncertainties ahead of us, given the energy issue that is a huge uncertainty for all of us? Is this what we want to do? Do we want to jeopardize whatever growth is to come in a year and a half from now? So I think that is my point here is that we are in a very difficult situation. And that brings me to the second point when it comes to the forward guidance and the communication. Now, we heard it this morning, but we had heard it before, that there will be more increases coming in the next meetings. Given that we live in such an uncertain world, is that what communication should be about? So, and here I think I said it also this morning, but I am a big believer that you need to have contingency scenarios, in the sense that you don't know what you're going to do, because information changes as you're getting there. So I think what's crucial in this respect is to sort of prepare for different inevitabilities. And you adjust as you come there. And so I urge for caution in the current cycle. Even though I believe that we were late to get here, I now advise for caution, because the information that might be coming to us may be actually very different. You could imagine a war being resolved in the next 3 weeks, or you can imagine a war not being resolved for another 6 months. The policy decisions and the transmissions on inflation are going to be very different, and therefore it is not advisable, in my view, to commit to a particular path right now while the information is changing so rapidly. And then the last thing, and there's a lot was said this morning, but one thing I want to also reflect on is the anti-fragmentation tool. There is a very clear difference between the US and the Eurozone in this respect. There is no need for an anti-fragmentation rule in the UK or in the US, but there is one. There is need for such a tool in the context of the euro area. Now, we have alternatives in Europe. We have something called the OMT, but we have other tools that the ESM has that could be dealing with that actually raise the question, and that's why I asked it this morning, why do we need a different tool? Why is there a need for another tool? The difficulty with applying this tool is eminent in my view. What is a spread that is justified by fundamentals, and what is a spread that is not justified by fundamentals? And if you are of the opinion that the tools that we're using, the economic tools that we're using to do forecasting are not ideal, then these are the same tools that will be informing that conversation. So a lot of acumen will be needed to try and understand what is warranted and what is not warranted. And perhaps one more thing on the tool, and then I'll stop. The way the tool was designed, the 4 conditions that the President talked about this morning, one of them is that the fiscal positions of the countries in question are sustainable. And somebody needs to make that call. Somebody needs to come and say, is this fiscal position sustainable or not? And the ECB has opted for deciding herself that what is sustainable or what is not. I think this is dangerous. I would have preferred that somebody else makes this decision, a much more political body, because it matters. Debt sustainability, at the end of the day, when debt sustainability comes into question, it becomes a truly political question. And I would have preferred for somebody else to do that. But okay, we know that they will consult with all the alternative institutions in the world, and if there is consensus across the board, it may be justified to do one thing or the other. I'll stop here. Thank you.
Philippa, the word Dezernat Zukunft, the name of your think tank, translates, loosely speaking, in the division for future, division being an administrative unit in the German public service. What do you think, as a leader who thinks about the future, in terms of monetary policy and the outlook? Do you see a different way of approaching monetary policy questions? Are you broadly kind of in line with what you see from the ECB and the Fed happening right now, or what is your assessment? Where are your concerns?
First of all, thank you for having me. I'll focus on Europe and the ECB because I think you're more qualified to speak on the US. So this morning what I thought was interesting is that President Lagarde was very clear on the differences between US sources of inflation and Europe, being very clear that Europe is supply-driven, it's driven by energy prices. I mean, she then had this reference where she said 60% is supply, 40% is demand. I would actually love to know the source. I think she's referring to something that Isabel Schnabel mentioned earlier this year in a speech as well, which is an IMF paper looking at manufacturing prices. I mean, maybe it's different if, Maria, you know, anybody knows what it is. Otherwise, I'd be curious. I mean, that's input prices to manufacturing with an interesting statistical specification. So I'm a bit hesitant. I would love to know where they take the 40% from, what the other source is. But she was pretty clear focusing this on energy prices and saying we have a supply shock, we have a cost shock in Europe, and this is where it comes from. And I mean, that's what the data looks like. If you look at consumption, if you look at wages, all of this is very weak in Europe, and the outlook is darkening by the day. If we look at consumption data for Germany, for instance, I mean, the dent for Corona has been so big, you know, you've never seen anything in history like this, and we are still at historically low levels. So, you know, trying to find overheating in this economy is really hard. We're really not overheating. It's people saving money. It's companies saving money because they have a huge cost shock. So we don't have too much demand in the European economy. And I thought her analysis on this was fairly clear. But then, and I think there I probably have a different opinion from others on the panel, then what I find hard to understand is the monetary policy reaction. Because what can monetary policy do? Monetary policy brings down prices by bringing down demand, because they make credit more expensive, so companies and individuals buy less. And then demand comes down, prices come down, and there's restraint on wage increases. Now, if we don't have a positive demand shock in Europe, if demand isn't particularly high, quite the opposite. Governments at the moment are trying everything they can do to stabilize purchasing power. Then why does the central bank jack up interest rates? And that's where I find it a bit difficult. I wouldn't go as far as saying, this is a big catastrophe and this is going to bring us all down, because if you look at energy prices, they're a much bigger cost factor than interest rates for companies. So I don't think it's that problem that's going to bring us all down. I also think getting out of negative territory is great, because negative interest rates are weird and cause other problems. But there I wonder. And I mean, thinking about the future and what do we really need to do and what do we really need to do to get out of this and to get out of the energy price shock. I mean, we need to invest. We need to get rid of fossil. And what we're doing right now is we're making capital costs more expensive. So I'm not really sure that's helping. I'm also, not sure it's the main obstacle. I think the ball is really in the court of governments. They need to act right now. They need to bring energy prices down. The central bank can't do it. But there, I'm just a bit skeptical of how actions of the ECB follow from their assessment of the economy, which seems to be pretty clear.
Geoffrey, we hear Philippa's concerns about possibly over-tightening. And there was also a very interesting paper the other day coming out from our former colleague, Maury Obstfeld, who said, well, we should also allow for the interaction of monetary policy decisions in Europe and the US, and of course in other countries that are tightening. Do you share that concern that there may be an over-tightening in the works, given where the Fed goes and where the ECB go right now? What is your assessment to what you just heard from Maria and Philippa?
I mean, certainly, the Fed tightening began earlier than others, but still the first tightening measures are feeding through about now, starting to feed through about now. And so when the Fed is communicating that it's going to continue tightening in this environment, then I think it's very important that they communicate why they're doing that, right? And I think that's part of what the Fed has been doing in recent communications. I understand the Chair Powell is speaking again today, so he's deploying himself in the public domain to try and communicate this. I think importantly to markets, because markets are a channel in which the tightening has to occur. And we were in a very interesting scenario where markets were actually loosening, right? Earlier in the summer, while the Fed was actually trying to tighten. So there was the market working against what the Federal Reserve actually wanted to do in terms of financial conditions. So I think this is something that's interesting. But the thing that I think is common now between the ECB and the Fed is they both have clearly reiterated their commitment to the 2%. And so in other words, the conviction is, there's no question the conviction is there to get back to 2% over the medium term, both in the U.S. and in the Eurozone. I think the question is what happens in the medium term, right? So you're concerned about growth outcomes. I actually think that we are underestimating, right, the kinds of shifts that may have occurred or accelerated in the past few years that took away the disinflationary kind of backdrop that we had enjoyed for many, many decades, right? Labor market liberalization that may have peaked, right? Supply chain optimization or trade that may have peaked less, right? The ability to upskill workers efficiently and quickly to meet new jobs, which may be harder or more resource intensive to do, right? The climate transition, which may be disinflationary in the longer run, could be choppy in terms of inflationary impacts in the short run. And so we don't really have good models for these things because we don't entirely know what exactly has transpired yet. But I think the important thing is to be humble in this environment, and I think the Fed and the ECB are both communicating that.
Then maybe turning to you, Andreas Dombret, you've of course seen many of these monetary policy considerations up front, but always with a view of financial stability in the background. Do you think that with what's going on right now, and with the exchange rate moves that these decisions have to some extent caused, amplified by the war in Ukraine, should we be concerned about tightening from the background of financial stability? Do you see any risks in that regard?
First of all, thank you for inviting me. I ever so often receive invitations by Atlantik-Bruecke, but this is the first time from the Atlantic Council, so I'm very grateful. You cannot have the cake and eat it. You know, it's not that if you don't do anything on the interest rate front, the economy will be well, or the other way around. You have to stick to your mandate. Each and every institution has to do what it is its mandate. We haven't talked about fiscal policy, we're talking about monetary policy, and fiscal policy is still there, and fiscal policy needs to do what it needs to do. But with regard to monetary policy and Madame Lagarde, it's very clear to me that there are only two ways you can actually act effectively against this high inflation. One is by reducing those bonds you have bought in the QE. This is a very long period until this will be effective, and you have to do it gradually. So it's not the most effective tool. And the second tool you have is the interest rate channel. That is the tool you need to take. There is no other way if you want to fulfill your mandate. And, you know, I heard what you said about forward guidance, and I agree with you, but I think it's important, after having been somewhat late, to be very clear in the communication that there is more to be expected. So coming back to my introduction, you cannot really fulfill your mandate as a central bank going and using the interest rate channel, and at the same time, making sure that the economy is doing perfectly fine. You have to accept a recession in certain circumstances. And if you read the speech by Jay Powell, the chair of the Fed, at Jackson Hole, I recommend it. It is a 10-minute talk. Normally, a Fed president speaks, I don't know, to an hour or 1.5 hours. He spoke for 10 minutes because all he needed to say, he could say in 10 minutes. So it's a short read, if I really recommend it. And this is why you have to make sure which way you go and which institution you represent and what is your mandate. So I would like to say a little bit, if I may, about this instrument, the fragmentation tool. Now, that was, I thought, the most interesting part of your interview with President Lagarde. You're totally right that there is the ESM, but what is more important is not only that if the ECB wants to decide when to launch the fragmentation instrument, even more so, markets will test the ECB on this. We just have to be aware. I'm not suggesting they should. I'm not asking them to do so, but knowing markets will go and test the ECB. Where is the point when the ECB will trigger this instrument or not? And this is ever so dangerous. And I'm just very, very, very critical that this instrument will be tested. The good thing, though, was that the ECB, in its decision, was sufficiently unclear when they actually will use this instrument. For God's sake, they didn't, put out numbers and say, if this point is reached, we're going to use this instrument. But I fear that the markets will use this instrument, and what will we do then? Then we are in deep trouble. I remember Mario Draghi when he said, whatever it takes, as long as it's in the mandate, and it was never tested. We don't want the ECB to come into a position where this instrument, the weaponization, so to say, of this instrument is actually tested.
Philippa, would you like to respond?
I was just trying to think why. I mean, obviously, you can say it's problematic, and there I fully agree with you, because you have, in a way, a politicization of the ECB, because they need to decide on debt sustainability, and I mean, especially also the question on what is a spread that is justifiable and that isn't. I mean, no one can tell. Like, there isn't such a thing. At some point when they go completely crazy, it might be a temporary thing, but there is no way of really delineating this. So from that perspective, yes, it is problematic. From an economic perspective, I'm not sure. I mean, that said, but there I see the problem less with the ECB than with the governments. Like, why do we need these instruments in the first place? Why do we have such a fragile setup in Europe? I mean, for God's sake, we're in a really difficult situation. We have a war. And in Europe, we really don't have any other problems than creating a very unstable institutional framework for the macroeconomy, for sovereign debt. I think we should work a lot harder, and this is on, is on governments. This isn't on the ECB. They're a technical institution. I think governments should work a lot harder to create a stable environment where it's clear when, sovereign debt is sovereign, and when countries can actually reliably borrow at cheap cost. And then maybe there's less need for instruments like the TPI. You will always have it at the margin where you have great political difficulties, but these instruments shouldn't be needed in the first place.
And if I may add, from a financial stability point of view, we do not have a mechanism to restructure countries.
Yes.
We still don't have that, despite all the crises we're having, and that makes me much more nervous from a financial stability point of view than central banks fulfilling their mandate and increasing interest rates.
Yes. The IMF, of course, having spectacularly failed many years ago about the sovereign debt restructuring mechanism.
Yes.
Maria, you at Bruegel, you think a lot about European architecture issues. So what's your take on what we just heard in terms of the fragility of European institutions? Are you concerned about that in the moment?
Well, I mean, the experience has shown that Europe, I mean, the architectural edifice steps up to the game when it has to, right? We've done it before. The pandemic reaction to from the European institutions has been exceptional. I never thought that we were going to see a mutualization of debt in my lifetime, and yet we saw it within 3 months when there was a need. Now, of course, the type of crisis justifies also the reaction. If you believe that the first crisis, the financial crisis, the euro crisis, I bundled them up in one, they were what they call the moral hazard crisis. This one, the pandemic, was not a moral hazard crisis. It was very exogenous, and everybody knew that we needed to do something together as fast as possible. And that motivated the discussion and made it what I call the Brussels all-nighters. They made them shorter, and they happened much faster, much to my amazement. This crisis here is yet again somewhere between the two, because there have been industrial policy choices that have been applied for many years, and you can see the vulnerabilities in the inflation rates, and of course in the quantities of energy demand. I wanted to say something about the anti-fragmentation tool again. I am not, I mean, so all this to say, am I worried about if something was to happen? I would have preferred a more clear game in the sense that do you think there's a problem or not? And do you want the ESM to be involved or not? And the reason, of course, why we didn't involve the ESM in the current circumstances in formulating this tool is because it's a toxic instrument. And this is something we need to work on. Why is the ESM considered a toxic instrument? The help that the ESM made available during the pandemic crisis, which was to finance health-related needs with no conditionality, was not taken up.
Right.
So countries refused to take it up. But why is that? Why do we have an instrument that we cannot use? And therefore, we need to create something else that in itself has problems. Yeah? So I think that there is an issue of architectural creation here that needs to be thought of. And the question is, why can't we see through that? And if I may, and reflecting a little bit on what Philippa said on what to do next, right? I mean, so the acceleration of the interest rate increases. I agree that we were late in coming into this game. So if you like, that was a mistake. But you don't correct one mistake with another mistake. And I think that's not the right thing to do. And you know what I think was interesting what Philippa said is that we have the investment needs in Europe to meet up with the climate and energy transition, but not just that. There's also the digital transition, and are enormous. Is this the time to be making the growth, the financing of this growth, all the more difficult, right? Now, of course, I agree that the mandates are such. Price stability is important for making a stable environment that is going to be conducive to growth. But you're not talking about a demand-driven inflation here. You're talking about a very specific type of inflation, translating into stagflation, namely the energy part. Solve the energy part, and then the rest is a lot easier to solve with other means as well, including with monetary policy. But I think the acceleration of the interest rate and the commitment to the acceleration of interest rates increases right now might actually prove wrong. That's why I'm advising for sort of caution. We might have to do that, but caution while we're doing it.
Now, we're supposed to talk about the dollar and the euro as reserve currencies here, but we were kind of leading into that. And one question in that regard I want to come back to, because we haven't really talked about exchange rates so far. And also in terms of, you know, the stigma of the ESM, again, from the IMF, we know there's a big stigma for countries coming to us. And surprisingly, like everybody expected during COVID already and later on, there hasn't been that much in terms of demand for IMF loans. Now, it's changing now, but it's not from the countries that you would kind of have feared, like the big emerging markets, for example, by and large, are doing quite well, despite all these exchange rate fluctuations and interest rate increases. By contrast, we're looking at the UK. The pound has just dropped dramatically because of, you know, various factors, various policy decisions. So, you know, how do we think about the spillovers of what's happening at the moment for the global economy? Would anybody of you like to speak a little bit to where you see the situation for countries outside, like the advanced world? Is there anything that worries you, and how should countries, how should advanced economies and international institutions react? Who would like to take?
As the German, I would then say something. No, because I mean, one thing is monetary policy, and obviously, especially the Fed tightening has big spillover effects, and I mean, maybe it will take some more time to feed through, but that's one side. But the other one is also global energy markets, right? And Europe and also Germany in particular, I mean, we've suddenly come up as the big buyer in the global LNG market. I mean, we buy whatever gas is available at whatever price. And what does that mean? I mean, that gas wasn't just hanging around somewhere before then, right? I mean, it went to countries like India, like Pakistan, like Bangladesh. And now basically we're pricing them out of the market. And that is a big problem. And if you combine that together with more financial strengths, I mean, you know, why can't we buy all this stuff? Because in the end, our government has got pretty deep pockets. I think it's a real problem. And we need to see these two interlinked, and international institutions, you know, with the member states that own them, will have to come up with some answers. Because also if we're asking for solidarity, you know, in sanctions, in, you know, being united, we can't expect that if, you know, we're literally undermining the fundamentals that countries need to survive. So I think we need to look at that very carefully, and it's a big problem on several fronts.
Yeah, that's a new transmission channel. Geoffrey.
Yeah, I mean, this is something, Martin, you and I were working on together at the IMF, right? What do we do? I mean, early in the pandemic, right, when countries were borrowing heavily in markets that were very low rates, and now the bill's coming due because you have to roll over into higher rate structures, and the market's choppier and may or may not be available at the price that makes sense. And so, to me, I think there's a huge need here to figure out the debt issue, because one, country can't grow with this kind of debt overhang, right? So they're going to have trouble growing out of this cycle without that. But two, there's a real need, I think, for the advanced economies who have essentially set the floor that they are now raising, right, on financial conditions, to find some way to help make up for the spillover effects in the form of grants, right? I think this is a time particularly for low-income countries, where grant assistance is particularly warranted. This happens to come at the same time where that's politically the most difficult thing to offer countries, right? So plenty of countries, donors are willing to offer concessional loans, right? Guarantee structures and the rest. But fundamentally, when you're in this kind of environment, coming out of the shock that you were in, and the shock that you still experience, right? Some of this has to be financed with grants, which are becoming scarcer and scarcer. So I think that's something that we should prioritize.
Okay, then thank you, Geoffrey, for that. We discussed that indeed, and it adds to the fiscal burdens, of course, that are already quite large. But I think there's a strong argument not to put further debt on countries that can't afford to pay back. But let's maybe move on to the second part of the discussion now, in terms of the role of reserve currencies, and many of the things we discussed will play into that. You heard about the paper that was released this morning, and I've been asked to say just a few words about it. The reason I was interested in that project, to talk about the international role of the dollar and the euro, was that there's a very strong debate right now, very rich, about exactly that, where people speculate what could happen to the role of the dollar and the euro now that we have cryptocurrencies, we have central bank digital currencies, we have a very strong, or used to have a very strong Chinese economy that kind of began to kind of grow also in international weight, that may have kind of trying to get a bigger international role for the renminbi. And now we have the geopolitical struggle and the sanctions regime imposed on Russia. So what does this all mean for the dollar as the predominant currency, with the euro a close second? And what this literature says is that, well, by and large, people are very optimistic that things will stay more or less what they are right now. We hear these arguments about the deep and liquid markets for US treasuries, the weight of the economy, the rule of law. Christine Lagarde mentioned some of those. And by and large, people say, well, look, there's not really an alternative out there. And so, therefore, people will always come back to the dollar and the euro. The network effects are so strong, it's kind of inevitable. What you will find if you have a look at the paper is that I, by and large, agree with that, at least for the short term. But there are some factors underway that kind of suggest that at least the situation is going to be a bit more complicated going forward. It's going to be a bit more multipolar. There are also academic arguments why greater multipolarity is to be expected. There's the issue of the Triffin dilemma, whether advanced economies can actually produce all these assets that are needed to maintain reserve currency status. And I would argue that, and there comes the geopolitical angle, as long as the US and Europe stay closely aligned, support the international liberal rules-based order, and maintain also a strong security presence around the world, it's going to be much harder still for any other newcomer or any other technology to replace the existing currency system. So that's basically the conclusion of the paper. And now I would like to start the second round by asking Andreas Dombret. You've been to a lot of international conferences, and the issue of the Chinese currency was always a big issue. How do you see the competition that the dollar and the euro are experiencing from the renminbi?
Yeah, thank you for that question. No doubt things have changed from the times when I was going to international conferences, because the global security landscape has changed so much due to the war in Ukraine, and due to the fact that this rules-based architecture we are living in and we have been living in has changed so sharply due to that invasion and is being challenged. And so what I would like to think about a little bit is not necessarily the relationship between the dollar and the euro, but rather the renminbi, as you ask your question, which is the elephant in the room or the panda in the room, so to say, big panda in the room. And because going forward, this is where more change will be than necessarily between the relationship between the dollar and the euro. Before I do so, let me state that I very much believe that your very good paper, which I read, is correct that the safe haven status of the United States on the US dollar is not really challenged right now. It's well established, but at the same time that there is no room for complacency and that you really need to think about what could change going forward. And all of this is creating, challenges in this much more increased instability in the world. Now, with regard to the renminbi, I believe that the renminbi and the usage of the renminbi going forward is the biggest known unknown we have in this architecture. And I'd like to go through 5 points real quick. First, some facts, at least as I see them. I don't need to say this in this forum, but clearly the People's Bank of China is not independent at all. So you're dealing with a central bank which is not independent, and clearly internationally the renminbi is not, it has very little liquidity yet and is hardly used. But there is some counter arguments. One of these international conferences I was in was when the renminbi was accepted in the special drawing rights of the IMF, and so they are there, and things have changed since then. That was in 2015, if I remember this correctly. And let's don't forget about that. And there is a panel after lunch about this with Elizabeth Kelly and others. There is a fact that China is at the forefront of using central bank digital currencies. And it is still a little bit unclear whether this could partially undermine other currencies and what this effect will be. And I think you'll hear much more in the panel with Elizabeth Kelly and the others on it. But this is really, there's a reason why China is interested in the renminbi, and the US dollar, being the reserve currency of the world, can sit back and watch and wait for this to happen, and why China is attacking and why the dollar is in a better position. But as we all hopefully agree, there's no room for complacency. That's my first point. Second point, in this decoupling scenario we are now in since the invasion, I think it's important to state that the international financial system, the IMF is part of that. The Bretton Woods institutions, as we used to know them, the G20, they are going down in significance. There is a scenario that the G20, Joachim Nagel talked about that yesterday evening at a dinner, is unclear what decisions will be taken in the forum of the G20, what decisions will be taken in the forum of the IMF going forward, if there are going to be several blocks and there is going to be a decoupling and a fragmentation. So in the past, we could rely on those Bretton Woods institutions. This is not likely to be the case going forward. And that has an effect on the potential rise of the renminbi. Third, also during my term, I remember that we ranked the banks into globally systemically important banks, and China was not part of that in the first ranking. Now they're all in those rankings, and they have very, very large banks. And I am not 100% clear in my mind to what extent those big international banks, they're not that international, but those big Chinese banks, that how much they actually work as a safety net or not. Are they a safety net, as international banks actually are, or do they rather undermine the Chinese economy? We are seeing the real estate problems in China right now, and it's not 100% unclear to me, without having all the full information, what this will mean and how this will play out in China. My fourth point is that in the past we have had a very important role of development banks. And especially in a crisis like this is what you do. The Germans, Philippa will agree, they turn to KfW, and we have a lot of development banks, and the IMF is one of them, and the World Bank, but there are more. IMF is not even a bank, it's a fund. But this role of these development banks, will that change? I think it could well change, and it could become much more regional, less multilateral, less global, because governments will block each other in these international fora. So we will have an inter-American development bank. We have, the Chinese founded their own development bank in Shanghai. We will have more regional development banking than we had in the past, and it's quite unclear what this actually will mean for the renminbi. And last but not least, please don't forget that China is the biggest lender cross-border worldwide. By the way, in US dollar. So they are they use the US dollar extensively, and there may well come a point when they choose to maybe change that to some extent. And how would that decoupling I've been talking about from China, or decoupling of China, if you want to look at that way, would that work? What would be the impact actually on their position? Belt and Road is just one example going forward. And don't forget that China has underlined with everybody but with every central bank in the world but the Federal Reserve, swap lines with everybody now. And they are very strongly interconnected, which was not the case in 2015 when they entered the SDR. Yeah. So we need to prepare for change, would be my easy conclusion. The international monetary system is likely to become much more multipolar, as you say in your paper, in the next years, and that will cause all sorts of challenges, and the renminbi is likely to gain in structure, pretty much in line with its growing economic, geopolitical, and financial cloud, and there is more to come, I believe.
Thank you. Geoffrey, let me ask you the same question, and you've seen it both from the IMF side and from Treasury, of course, US Treasury. So what do you think about the future role of the renminbi? Should we kind of be okay with them getting a bit more stature? Should the US and Europe possibly take actions to defend the role of the dollar of the euro? Where do you see this competition evolving, and what should be done?
I mean, maybe it's because I'm a bit of a marketeer, but I think the competition angle is the right way to think about it, right? Because I think that's a healthy dynamic that would encourage better growth and outcomes for China, better growth and outcomes for the US, better growth and outcomes for Europe. Madame Lagarde walked through a few things that she thought, right, would be conducive, not just for the role of the euro being more internationalized, but for the role of Europe in global markets and in improving European economies. I think from a US perspective, there is a risk that we've taken this for granted somewhat, right? And the number of policymakers that can explain in the government how we got to be a reserve currency and why we can maintain it are fewer and fewer, right? And they're still there, right? But some of them are retiring, or new crops of folks are coming through. And so I think the competitive issue for the U.S. is, as this competition for reserve currency status wages on, what kind of policy discipline does that reinforce on the U.S. as the current issuer of reserve assets? And I think the more you've cemented your place, there's more of a risk that you actually loosen your discipline or your focus on the things that actually got you there, right? I think we're talking about several of these today, but fiscal discipline, I think, is something that needs to be focused on. That is difficult in the post-COVID environment, but I think something that's deserves another look at. Politically, that's hard to come by on either side, frankly, right now, right? I think there's a question about how the recalibration of financial regulations, right? How you balance openness and access and efficient capital allocation with safe markets, fair markets, right? Markets that people trust. A difficult balance to strike. And then sanctions use, which we'll talk about later on. So, if people began using your currency out of the knowledge that it was freely usable, right, and then it becomes less freely usable, that trade-off has to be fully internalized so that you don't. I always liken it to antibiotics. You can take antibiotics the first time and it's quite potent, but the more you take them, right, the less effective they can be over time. And I think that is a factor here in the reserve currency as well. And I think the last thing is policy stability, just more broadly, right? Which and so again, if you think about the competition among those four fronts, that's healthy among issuers of reserve assets, and it'd be healthy for China to compete along those lines as well.
Thank you. Philippa, may I turn to you? And one question intrigues me. I mean, you've been working in Africa. And Africa is, of course, economically speaking, not of the same order as other continents or Asia or Europe. But the battle for reserve currency status, that kind of China is, well, I don't know whether it's a battle, but the initiative that China is pursuing rests a lot on their relations with the Global South. And how do you see this from, if you put yourselves in the mind of Liberian finance minister or colleagues, how do you see this kind of playing out from the perspective of Africa and developing countries? Do you have any thoughts that you want to share with us?
Yeah, it was interesting. I mean, when you said China now founded their own development bank in Shanghai, I mean, they actually have a whole suite of different development banks already that offer loans in different variants of, being more concessional or being more commercial. They're a huge player. I mean, we always talk about China, something that's gonna happen in the future. When you sit in the Liberian finance ministry, China is happening. And it's a completely different world to before. Liberia is traditionally very dependent on the US. The US has a very, very strong presence, also very strong military presence. So, the US is everywhere. And suddenly, China is there. And full on, with a lot of very smart people, and they offer you whatever you need. For us, actually, and now I'm speaking from kind of Liberian perspective, that was actually pretty interesting, and I think pretty good, because China introduced also some competition there. So, when the US can walk in and they can tell a government to do whatever, that's not a healthy dynamic. And we had the alternative. We were able to walk away from the US and talk to the Chinese. And actually that was, I think, quite helpful for us. I mean, now switching back to kind of our conversation, you can definitely see that China is very interested in pushing, their loans and also their currency. So I was just trying to remember, I think the loan terms were a lot more concessional if it wasn't dollar, if it was renminbi. China also has the biggest road building companies in Africa. I think even for the World Bank, the second biggest recipient of funds to actually do stuff with it is a Chinese company building roads everywhere in the developing world. So if we work with them, it works to take renminbi. Otherwise, obviously everybody wants to work in dollar, but this is one of the things that they're really, really trying to change, and didn't even become the second official currency in Zimbabwe, or I think so. Mm-hmm. So, I mean, really fascinating things going on, considering, liquidity in global markets still isn't there. So there it's already arrived, it's much more active, and you can really see those pushes. I mean, that said, I think that's completely separate playing field from international financial markets.
Right. And of course, there's the issue of the excess debt that some countries have accumulated, and that needs to be in some way resolved. Maria, turning to you, you had this question to Christine Lagarde about the international role of the euro. Let me ask you, so assume that the euro had already a stronger standing as a reserve currency with some of these market reforms that you had, that she had also mentioned. Do you think Europe would be better off at this point? Would a stronger euro help at the moment, or do you think that it wouldn't really play such a big role? In other words, do you think the euro should kind of work toward a stronger international role also in the future?
So you had a wonderful graph up just a few minutes ago on the currencies. So if you could probably put it back up, the euro dollar and the I think you had the pound dollar, and I think that what's interesting about this graph, here we are. No, that's inflation rate.
There it is.
No, I think that's here we are. The blue. Here they are. So the blue line, right? And I think that is the blue line, right? Yeah. So the question is, do you think that what's the trend here? I mean, if you take the trend of the currency, where do you think the euro is now vis-à-vis that trend? To answer that question, because I mean, the exchange rate is a very strange animal, and if anybody has ever done research on exchange rates, you know how can you predict anything? So the only thing you can really do is exactly look at this graph, which is where are we vis-à-vis where we have always been, and it's not obvious to me that I see in this graph any trends that are troubling. I don't see anything there. And if you look at the effective exchange rate, which is traded weighted, I looked at it just before the summer. I don't know where it's now, but there it was very much on historical averages, and there is no issue of concern. So that's one thing that I can take from this. The second thing I'll say is that we have a kind of love-hate relationship with exchange rates. We don't know whether we like strong currencies or weak currencies. And certainly economists have this, and I know that's not true. That we like strong currencies, but when strong currencies move up or they move down, this is what we're not so clear what we think about that. A continent of exports, and I mean I'm in Germany here. We like the currency not to be quite as strong because it gives us market share. But also, it's an issue of underlying fundamentals. If you have a currency that is weak for very long, that's not good. So, that's all I have to do your question. I don't think that the exchange rate really is an issue right now, other than the symbolism. Well, certainly when it hit the parity, that was symbolically very big. But beyond that also, the camp of people who say when we see a strong currency coming down, we don't like that. Well, I just want to remind you there is another camp that can benefit from it. Mm-hmm. So I don't know that we need to dwell on this issue, unless this graph becomes very different. And that brings me to the green, where, there is issues here that are fundamentally interesting, if not worrying. There are things going there, and of course they have to do with choices that have got effects we will see in horizons of 10 and 20 years. And of course I'm talking about Brexit here. Now, I loved all the points you made, Andreas, because I think there was lots to digest here, and it has repercussions for the euro as well. Your line about preparing for change, I think this is one that we should all listen to that. The issue of decoupling, I think, is absolutely essential because we don't know where we're going to end up. Are we going to end up in a sort of a multilateral system where we have one anchor, typically what we have up till now, or are we going to end up in a bipolar system where one anchor is, let's call it the dollar, Western anchor, and then something else based on China. China is 1.4 billion people. Europe and the US is about 800. So yeah, the direction of travel is one in which China will want to sit in the global table and will also want to be holding the pen when we write new rule books. I mean, I'm thinking of the WTO in particular, which is the one fora that we have for engaging. I think China will want to hold the pen, I think, when we rewrite this book, and the question is whether we're going to rewrite it. And here the US, of course, is pivotal in facilitating this or not facilitating this process. And of course that comes to the currencies. One interesting, I sound a bit random, but there is a very big issue, and there is interesting things that link to the currencies. The issue of the digitalization of currencies, and I can see Africa being interested in digital currencies because their alternative sovereign currencies are weak. I think very differently about it, the attractiveness of digital currencies in this part of the world. I just don't think they add much. Certainly, the central bank digital currencies. We'll hear about this later on, so I'm looking forward to that. I think there is no future for private currencies, and the bottom line for this is trust. And it comes also back to China, and whether the Chinese currency will become a dominant currency or not will rest very much on the very issue whether we trust it to be a good currency or not. not. I mean, it is so important to have trust in currencies, and by I believe that sovereign currencies in this part of the world will always dominate. They will not be taken over by the bitcoins of this world, simply because they are assets. They're not real currencies. They're not good money. Right. They're something else. I think I'll stop here. I think I went in different directions.
Andreas, Geoffrey, would you like to respond to anything that was said? Then we need.
I would like to make this even a stronger argument, if I may. I'm less diplomatic than you. I think that these cryptocurrencies are a scam. Yeah, and not the central bank digital currencies.
No.
Don't get me wrong. Yeah, but I'm talking about these. There is a scam. I hope that nobody is going to sue me over this. And, I'm not whoever. But this is, they are assets, and you can invest in them. But they are not currencies. They are not. You don't really need them for payment. They're so. I wonder. Yeah, but China is. With its digital currency, they don't want the Bitcoin. They don't want money to leave China. They want to control everything as much as they can, and that's why them experimenting with the digital yuan is a very logical thing, and that's why they are so much in front of everybody. And they are putting pressure on the euro. They're putting pressure on the ECB to act. Yes. Whereas the US dollar. 60% versus 20% in Europe. The US dollar can relax and they can watch it, and they are working on it, and we'll hear about this in the next panel. But they're much more relaxed. Whereas Europe, given its position, which is much weaker as a reserve currency, they need to do something about it. And this is why, of course, we would like to have a stronger euro. Then we wouldn't be bound so much to react as we are now.
Yeah, I mean, I remember China was a leader already in digital payments in the private, so to speak, private sector in China, and the reaction came to have this CBDC. We'll leave the legal issues to the next panel in terms of cryptocurrencies, and now turn to the audience. And if there are questions, I see Charles, and then the gentleman here, and then there's one in the back, and then there. Okay.
Hi, Charles Litchfield, no affiliation. My question is about the news that we've just had from the UK. And for those who don't know, I'll go into that in a moment. But the panel hasn't mentioned QE very much, because QE is being tapered or ended. And yet the UK or the Bank of England has just announced that it will be intervening in gilt markets and buying some of them, given some turmoil we've recently seen. So I'm interested in the panel's opinion on the UK and why that might be, but I'm also interested in more general terms in whether in the long term central banks will always be brought back in to intervene, just because we're now used to this. It's something when we see turmoil that QE is there's an expectation for central banks to intervene more, and that we might see that role broadening in the future. Thank you.
Thank you. Maybe we'll go to the two gentlemen first here. And then in the back. Mm-hmm.
My name is Michael Frenkel. I would like to point to two aspects that haven't been touched upon in the context of the potentially increasing role of the RMB. One isn't one impediment for an increasing role of the RMB the lack of convertibility? This is one. And the second is, if the world on a net basis wants to acquire assets vis-à-vis China, that would require a current account deficit of China. Is China prepared for this? What do you think? Thank you.
Thank you. And
yes. Thank you. Elmar Hellendoorn. On China, which has of course emerged as one of the largest creditors to the emerging world, it's very reluctant to work with Western countries in debt restructurings. First, why do you think that is? And second, since we're talking about US-EU geoeconomics, how can the US and the EU work together to bring China to the table, to work together with the Paris Club, for example? Thank you.
Thank you. Since there were no specific questions to any of you, who would like to respond to some of that?
Maybe we can split up the central bank questions and the more IMF type of questions.
Sure. Go ahead.
Okay, so QE, and I haven't heard the news. Whoever asked that question, I think it was you. I mentioned actually that there are two ways of bringing down, reacting as a central bank. One is by reducing the amount of bonds you have acquired during the QE and then using the interest rate channel. And I mentioned, and I'm happy to repeat, that by using the interest rate channel, the impact is much more direct and much quicker, despite the fact it still comes with kind of time lag. Now, the UK has started its journey of normalizing interest rates also before the euro area. And so they're advanced. Right now, we're living in a world that whatever has been bought in terms of QE is being renewed, but nothing else, no additional acquisitions will be taken. Of course, we will come to a point where we'll have to reduce the balance sheets of the ECB and of all these central banks, and the US has started, the UK is following. I think this is how it should be and what I would expect them to do. Still looking forward to reading the news, though.
Maria, would you like to follow up? And maybe also on the question, I guess it was kind of a sense of central bank independence, right? Will central banks be roped in and will have to continue to finance budget deficits?
Yeah, very important question. I mean, I have nothing to add on this issue. I think the QE is now is no longer an unconventional tool. It's a conventional tool. It will be used. And the question is, when would that time, so the reduction of the balance sheets happen? And that is going to be part of the decision making. I think that's all I can say about that. And that, of course, the problem with big balance sheets is the issue of independence. And therefore, we have a central bank DNA today that is very different to the central bank DNA 10 years ago and 15 years ago. And in fact, we're going to have to rewrite, I think, the Monetary Policy 101 with now this issue of the independence. I mean, if you think about the traditional models where we're talking about central bank independence, how does QE feature in that? I think that is a very important issue, and it's going to define that part of the literature, if I may call it this way, the independence of the central bank, given the size of the balance sheet.
Especially in the UK.
Yeah. Go ahead.
No, you go.
No, I insist. Ladies first.
Okay. Just very briefly on Q. Completely agree that it's a political issue. Just want to make clear it's not a monetary policy issue, because today we have different monetary policy regime. We set interest rates and we can set them with excess liquidity, and this is what we've been doing over recent years. Especially in Germany, people are sometimes worried that, there's too much liquidity around, so we can't control it. No, this is not the case. Setting interest rates separately from that. So it's more a political issue, and I think especially in Europe, where this defines whether bonds are really sovereign or not, whether the ECB buys them or to what extent. That is the difficult question. Just really briefly on China and debt restructuring, what can we do? Don't call it the Paris Club. I mean, how would you feel as China to go to the Paris Club? Just take that label away and make it something where they can feel they also have some ownership in it. I think that would change a whole lot.
Yeah, maybe on the China question. I mean, worked on the China Article 4 at the IMF for years, and this is obviously policy advice the Chinese have received, right? Which is, how do you rebalance your economy so that you can allow for global imbalances to start correcting themselves. So I definitely think they understand this. It's a question about how they put the machinery in place to actually make that adjustment, because it's been a multi-decade ride, structuring the economy in a one-way direction, and reorienting that is a challenging, engineering problem as well as a political problem in China. So certainly, I think what I would hope is that is not delayed, or the progress that has been made doesn't reverse as a result of policies that are in place for emergency reasons, right? For COVID or energy or otherwise. That this actually continues moving them in a place where the economy is the demand side of the economy comes online. There can be some rebalancing, and the world is a little bit better off. On the QE side of things, I think, I don't repeat what was already said, but I do think there is this part of the DNA, maybe this is the DNA of policymakers, not just central bankers, but the DNA of policymakers has gotten very ingrained with living in a world of low volatility of all sorts, right? So low volatility in geopolitics, lower volatility, and even in their domestic politics for some time, lower volatility in financial, and this is all starting to unwind a little bit. These things are shifting. And I think we have to be careful about what things we do because we're just uncomfortable with the volatility, and maybe the volatility is telling us something, right? And we should find ways to address the root causes and ferret that out. But a big difference, right, between the central banks and the fiscal side. And I think in your first comments, you talked about the fiscal side needing to do the lifting. Fiscal side needs to do the lifting, fiscal broadly, so not just the spending, but the mechanisms of government, right, of policymakers and legislatures really need to hone their focus a bit in this environment because they don't have the luxury of these volatility suppressants that were in place for some time, and now they're going to have to make tougher decisions to get where they want to go. We can't rely on central banks forever to kind of be the shock absorber here.
Thank you. Maybe one word from me on the debt restructuring issue in China. It's a very domestic problem in China because there are various banks and agencies involved, and the internal coordination process of China is very difficult. Now, the issue here is that the IMF and other institutions have tried to point out that problem and actually educated China a lot on what other countries have done in these situations. Mind you, other young dynamic economies have done the same thing, extending a lot of loans abroad that then came back to haunt them, and it's nothing kind of extraordinary. It happened before, but I think the patience has been wearing a bit thin. The common framework has been kind of a compromise approach to apply some Paris Club principles, if not policies. But one interesting question will be going forward: how long the international community will kind of tolerate that slow reaction of China, and also the nature of the restructuring. China uses to kind of extend loans, they roll them over, but is very reluctant to grant haircuts, and that may be necessary in some cases in the future. Now, we had Doug there, and then are there any questions on that part of the room? Gentleman here, okay. So please, Doug, and then we'll go over there.
Thanks, Doug Redeker. I want to be a bit provocative, if I may, and sort of seed a question which might be more appropriate for one of the later panels on economic statecraft, but I think it's relevant to this panel as well on reserves. There is talk in the US and elsewhere by some circles about taking central bank reserves of the Russian central bank that are currently frozen and repurposing them. So they are currently frozen, but instead of just freezing them, seizing them and using them for the purposes of Ukraine reconstruction. While admirable in its intention, I'm curious what the panel believes the consequences for global central banking reserves in general would be if euros and dollars that the Russian central bank has used as reserves, traditionally seen as sacrosanct, would be used for, even if they are admirable, for purposes beyond which central banking reserves have traditionally been seen as being available. What that would do to, for example, China's $1 trillion of U.S. reserves, and what you think the reaction would be both by the Chinese central bank, by others who are holding in euros and dollars, and what that might look like in terms of reserve composition as per the slide that is not up there now, but that's been up there most of the last hour.
Thank you. Please.
Moritz Lüttgerath. I'd have a follow-up question for you, Philippa. If I understood you correctly on the regarding the section on ECB policy, it seemed to me that you were rather critical of the measures the ECB is currently taking and planning to take going forward, given the weakness of the euro area, which you can see in different data points. And I get that. I'd be curious whether you could perhaps elaborate a bit more on your concerns, because, I mean, there are some more, some other challenges that you didn't mention, such as, sort of the ECB being in the context of a global tightening cycle, with the Fed obviously, first among them. And that obviously, if you look at the currency development, is a factor that plays into the consideration likely as well. And the other being that there is also a consideration regarding inflation expectations potentially, as well as, and you want to, sort of keep them anchored, as well as the fact that the ECB currently still is in has a stimulative policy stance, right? And we're facing a supply shock that, sort of, that if the ECB maintained that, stimulative stance, would perhaps just feed into higher energy prices and then, perpetuate that inflationary outlook. So while I get your point, I'd be curious how you navigate these downside considerations. Thank you.
And then it over directly to you.
All right, I'll try and be brief. Exchange rate, and I mean, that's essentially the global tightening cycle, the context you're in. The ECB doesn't target exchange rates. And if fundamentally the reason to tighten isn't there because you don't have excess demand, then I find that a bit tricky. And I mean, I agree with Maria. Like, this is going to be a really, really huge worry to kind of just overturn what your, primary mechanism is. This shouldn't be primarily about exchange rates. This is about whether we should dampen demand to get inflation down. On expectations, yes, that's an important one. I mean, the expectations are coming down to 2%. Expectations, and I found this interesting, in the very short term for Germany are 5%. They are far too low. I mean, there's no way in 2022 we will be at 5%. It's mathematically impossible. So, I wonder really whether there is an issue of the anchoring. If they're higher for next year, I mean, yes. Anybody who doesn't think inflation is going to be higher than 2%, I mean, hasn't looked at any data. If you want to be sure about expectations, I think there are better ways than to hike as much as you can now, and especially and that's what the communication I think has been in the past, especially 2-3 weeks, is like, say that you're going to be particularly forceful and that is going to do something. It's not going to do anything. I think there are better ways. First of all, I think get your projections a little bit better. I mean, that's always an easy criticism, but I think in this one it's a bit justified because just the way energy prices feed through to consumers, that takes a while. So the ECB has always projected that inflation is going to go down kind of in the next forecast point, and I think that was actually impossible to happen. You could see that this is going to last for a bit. So if you want to instill more confidence, get your projections right. And then, I mean, on policy, be very clear on when you're going to act. So, say when you have, wage rises that go beyond anything reasonable, we're going to act. If we see anything in demand, we're going to act. Be really clear about what you're going to do there. I think that does more for expectations than to pretend that you can do something now that you can't. They won't be able to bring inflation down right now. I think, if anything, that is detrimental to expectations, and that doesn't really help. So, yeah, I mean, playing through all these factors, I find it hard to see, and I think the best a technocratic institution can do is to be really clear about the channels, the tools they have available, and then to set clear expectations about what they can do when.
Yeah, I very much volunteer to answer Doug Rediker's question on the sanctions.
Oh, me too, actually.
And everybody on this panel wants to. So I'll go first. And I try to be diplomatic, but clear. I don't want to really talk about the potential of anybody seizing Chinese foreign reserves. But let me make one thing very clear, Doug. Sanctions actually are very important as weapons, but these weapons need to be used appropriately. And I would actually very much believe, we do need a multilateral sanction system, which we don't have. And this is, I would extend your question to that. And that would include your question about foreign reserves and FX reserves of, let's say, whoever. So we don't have a sanction regime, and as long as we don't have a sanction regime, sanctions are weapons, but you have to be very careful, and you may not use them inappropriately. That was my diplomatic answer.
If I may, I think it would be wrong to, if I may be less diplomatic, I think it would be wrong to confiscate the assets right now. I think it was very strange that the assets were frozen, not because it was unwarranted, but because it weaponizes it. And it's interesting to see what this will mean for the future, how central bank reserves are going to be used in the future. So I think it would be, if you were to confiscate the assets now and use them to finance the destruction of the Ukraine or whatever, you will be bypassing the multilateral system. And I think it's so important that the only thing we have is the multilateral system. And that brings me to the original question about how to involve China on what the EU and the US can do to bring China to the table. Well, I mean, that is, use a multilateral system in which we agree on what the rules are and not present China with a fait accompli of what the rules are, by the way, for a system that is very different to ours, better or worse. I mean, we have problems with it, but China is huge. You can't imagine how you're going to solve climate without China on the board. And if you start with that, then you have to work backwards and sort this out. And that comes, of course, back to that question that if you were to confiscate assets right now, what message are you giving to the world about who writes the rules, who imposes the rules, and who monitors the rules? I think this is the important thing. So therefore, that's why I think the question of decoupling is very worrying to me, because decoupling means that we will never be able to solve problems like climate, which, by the way, are the one global public good that requires everybody around the table.
So Maria is saying the same thing. The dollar can only be weaponized when appropriate. And that is a very high.
Absolutely.
Very high.
On that note, I'm afraid, and I have to apologize to our hosts, that we've been running a little bit over. But the topic, as you saw, is very broad, very complex, and very interesting. And I think we had a fantastic 4 panelists today, and I ask you to join me in a round of applause for a very good discussion. Thank you.